I'll kick it off.
All right, let's do it.
All right. Well, good evening, Gauchos. I'm Julie Mickleberry. I'm an alum from the class of 2001, and I'm also the Associate Director of Alumni Affairs. And on behalf of UC Santa Barbara alumni, I want to express our gratitude to you for all joining us today for the June edition of Gaucho Academy, presented by American Pacific Mortgage. This webinar series features keynote speakers and expert panelists who delve into topics pertinent to our Gaucho community. And tonight, I'm delighted to introduce Jason Maida, who will be leading tonight's home buying workshop and working his magic and answering all of your questions. So I'll hand it over to you, Jason.
Awesome.
All right, thank you so much.
Awesome. Thank you so much, Julie. I appreciate it. Thank you so much for the warm introduction. I'll also appreciate everyone joining this evening. I know you have lots of things you could be doing on a Tuesday night, but we appreciate our Gaucho alumni hanging out with us to learn a little bit more about home buying. This is a class that we generally offer once a quarter. And so hopefully if you like some of the information you hear this evening from me, you'll share that with your friends, family, maybe some of your colleagues that are also trying to learn a little bit more about home buying. As Julie mentioned, our company is called American Pacific Mortgage. We're a direct lender out of California, so Northern California, but we serve across the entire nation. My team in particular, we specialize in home buyer education. So educating you on what the next steps look like for home ownership for you. Tonight's class is a very interactive session. So as I go through tonight's content, obviously we're screen sharing right now, but we're gonna share all the information back to you in a recorded version of tonight's class. But we would also encourage you to ask questions as we roll through tonight's class. It's gonna be very interactive. I'll pause for some questions. You can use the Q&A or chat function within Zoom, and I'll retrieve those questions and answer those on air for you. Again, my name is Jason. I'll be your host and presenter this evening. Just a little bit about me. I am obviously your presenter, but I specialize in first-time homebuyer education. So I have the pleasure of teaching classes like this all across the country to various alumni partnerships that we have. We also do some corporate involvement with, like, Starbucks, for example, is one of our that we get a chance to teach classes to some of their team members, just to really help people better understand a little bit more about what's probably going to be the largest upcoming financial decision they have to make. So as we kind of look at tonight's class, here's some of the key topics. We're going to talk a little bit about the housing market in just a bit. We'll spend some time looking at interest rates. We do launch into tonight's class looking at a budgeting exercise of comparing what it looks like from a rent perspective versus what it could look like from an owning standpoint. We'll spend some time looking at credit, how to maybe get your credit in the best possible position, and maybe have a few takeaways of tips and resources for your credit. We'll talk a little bit about student loans and how those can impact qualifying. We'll look at loan programs, some of the documentation you'll generally need as you start this path towards home ownership. We'll also look at first-time homebuyer programs that are available in the state of California, but all across the country that you can maybe take advantage of. And then finally, we'll kind of wrap up tonight's discussion looking at the loan process. So if after tonight's class, we're saying, hey, you know what, I think I want to learn a little bit more about home buying. How do I put together a plan for myself? We're going to walk you through what that step-by-step and the different milestones might look like for you. All right. A quick question for our audience. I'm always kind of curious because I know most of us are probably in California, but if you get a second, pop in the chat where you're joining us from. Love to kind of know maybe if we have some folks that are joining us from out of state, outside of California, as we kind of look at some of our market data in just a bit, might be helpful to kind of understand where you're joining us. So if you get a chance, pop in the chat, just kind of your city or location that you're joining from tonight's class. All right, so let's talk a little bit about buying and does it really make sense for me? Like I've just mentioned to you, this is probably going to be one of the largest investments or financial decisions you decide to make in the upcoming future. And I think it's important to understand what the benefits that come along with owning a home. For example, as you purchase a home, you have the ability to be able to kind of control your monthly expenses in terms of what's going out towards the housing budget. This is a home that will hopefully increase in value over time. The difference between what you owe on that house versus the value, that's the equity based upon the appreciation of the home. This is an asset that, as it does appreciate over time, hopefully has the opportunity to create generational wealth for you. as well as tax benefits that can come along with owning a home. So when we think about comparing our existing budget today as a renter, perhaps, versus what it could look like as owning, I would say it's not necessarily an apples to apples comparison. And so as we take ourselves through a budget, which we're going to do in just a minute, we want to kind of take that in consideration. So there's a lot of great benefits that come along with owning a home. Now, before we pop into the budget calculator, I want to just kind of get a sense of where everybody's at. So I appreciate those that kind of dropped our location in the chat. So most of us are in the California market. So, okay, cool. A lot of us in Santa Barbara, Fullerton, Pasadena. Awesome. Okay, very cool. That's always kind of interesting for me to see because, obviously different markets look different across the country. So if most of us are in California, that'll kind of help me kind of cater most of our conversation to California markets per se. So let's now spend some time looking at a rent versus buying calculator. And this is brought to us by Freddie Mac. When you think about conventional loans, which you're going to learn about tonight, conventional loans are Freddie Mac, Fannie Mae based loans. And so this is kind of a tool that we have on the Freddie Mac website. So we're going to kind of walk through this calculator together to do kind of a what if scenario for you in terms of home ownership. And so I'll kind of walk you through this. We'll come out with a result of what it looks like in a side-by-side comparison. And so we'll first start with some data points here. So we got kind of the renting side of the equation here, which is we have a $3,000 a month rent. We assume a $15 renter's insurance within our budget. We're also going to assume that our rent's going to go up about 5% on an annualized basis. So as I decide to renew my lease, with my landlord, my rent would potentially go up by 5%. We have a purchase price of a home at $700,000, minimum down payment for a $700,000 home price as a first-time buyer is 3%. You're going to learn more about that in our loan program section of tonight's class. We have estimated property taxes, homeowners insurance, and then we have the maintenance costs of the home. So that kind of gets plugged into our equation. And then we're going to skip to the loan information tab. So we're going to have the 30-year fixed mortgage, which is typically what most first-time buyers are going to elect. We have estimated interest rate. That can change, obviously depending on the timeline and when we decide to buy, but we put in 6.75 for our discussion tonight. We have origination charges. Those are going to be costs that your lender has in terms of the charges or closing costs you have for your financing. Now, one of the cool things we have with our Gaucho alumni partnership is that we actually discount our cost by $750 through any of our lending services that we provide to you for either a home purchase or even a refinance. Now, there's other closing costs that come through purchasing a home. There's things like title and escrow fees, some of the government charges like transfer taxes. Those are all part of total closing costs in purchasing a home. Now, when you elect financing options, there's also a thing called discount points. And you're going to learn a bit more about interest rates in just a bit. But what a discount point does is allows you to bring down that interest rate to perhaps bring your payment down as well, too. One discount point is the equivalent of 1% of my loan amount. So if I financed $500,000, I elected to pay 1% of my loan amount. That means I paid $5,000 in expenses to bring down my interest rate. Now, generally speaking, 1% of my loan amount will equate to about a 0.25% reduction in interest rate. All right. And then we have other assumptions that we're going to make. We have the appreciation rate of our home, about 4% on an annualized basis. We have expected years in our home, 7 years. We have the selling cost. So eventually when I sell my home, about a 10% expense ratio there. Then we have state and federal taxes. And then we compare that to a savings rate of like 3%. I know there's higher savings rates. But ultimately, what our calculator is going to come back to us is it's going to show us a side-by-side comparison of renting versus what it could look like buying over the next 7 years. Now, the rent expense is $3,000 a month. We jump that to a mortgage payment. That almost doubles our outgoing expense on a monthly basis. However, if we factor in equity appreciation over the next 7 years, we factor in tax benefits of owning a home, we probably have about a $65,000 upside of buying versus what it could look like from a rental perspective. Now, so when we think about renting versus the buying, those are some of the things that we want to factor into that analysis, because really, when we look at owning a home, there's so many great things that we want to consider, but we also got to consider the increase that we're going to have, especially in today's market from a monthly budget perspective. All right. Thanks for those of you who are putting your locations in the chat. I did have one question that came in. And let me just kind of go through this really quick. Got the certificate without knowing this. Okay. This is more kind of a specific question. I'll go ahead and take that one off air. But we'll, again, if you do have any questions in tonight's class, you can go ahead and drop those in the Q&A or the chat, and I'll get those answered on air. I did get your question that you just put in regarding the home buyer certificate. We'll talk about that a little bit later in tonight's class when we spend some time looking at first-time buyer programs. All right, so that's our rent versus buying calculator. Let's kind of transition into the housing market, what's going on with the housing market. This slide kind of shows you what the California markets are doing right now. Not really different than most parts of the country. Why we see this kind of huge move, like from a median sales price perspective, is really attributed to lack of inventory. Even though we're in a relatively high interest rate market compared to the historical averages, home prices are still going up. So we have limited inventory, still have demand that's pushing those prices up. And, you know, that's probably going to continue a little bit more given what we see in today's market. We are expecting about a 10% increase year over year in available inventory. But, you know, with even today's interest rate levels, there's still a strong demand out there. Now, we're going to talk about interest rates in just a second and kind of, you know, what some speculation is around interest rates. But as interest rates eventually, and they will eventually start to come down, that will push buyer demand up even higher. So the question mark is going to be, you know, how much more inventory do we have coming to the market? And why do we have the challenges in inventory? Well, most of the existing homeowners that have homes today really don't want to replace those homes with 6-7% interest rates by maybe moving on to the next property, right? Because many of those existing homeowners refinanced at 2.5-3% rate loans, and it's really hard to double your interest rate or more when it comes to kind of moving up to the next house. And so that's kind of, we have this a little bit of a dilemma in the housing market when it comes to inventory. Builders are trying to offset some of those challenges by building new homes, but not all markets have land to be able to buy, to be able to build on, right? So some of our more densely populated areas, like the LA County market, unless we're going to go further out east, makes it a little bit more challenging to build for new construction. So inventory will continue to be a little bit of a challenge for us in today's market. Now, from an interest rate perspective, you know, we're in this market right now in interest rates where we're just trying to kind of find where interest rates are going to go. As we look at this slide here, this represents both the 30-year fixed mortgage rate as well as the 15-year fixed mortgage rate. I want to kind of spotlight the blue line, which is the 30-year rate. And you can kind of see where interest rates have gone over the last 12 months. Looking back at in October, rates actually hit a 20-year high at 8%. Now we've fallen from that level, thank goodness. But certainly the road's been a bit choppy from an interest rate perspective. When we look at today's interest rate market, we're trying to find out, where's this market going to go? Now, why are we here right now from an interest rate perspective is really, you know, important to understand, because right now we're in a high inflationary environment. We all feel it, right? The cost of housing, the cost of goods is all more expensive. And the Federal Reserve has tried to combat inflation by raising interest rates. And that's kind of what we've seen over the last year and a half, 2 years. The question now is, when does the Federal Reserve start cutting interest rates so we can start to see some decline in interest rates? There is some speculation that at the September meeting that the Federal Reserve will start to cut interest rates. But the inflation goal for the Federal Reserve is 2%, and we're still not there yet. Tomorrow's a big day from an interest rate perspective because two things are happening tomorrow in the economy. One is the Consumer Price Index report is being released tomorrow at 5:30 a.m. our time, 8:30 Eastern time. But that indicates kind of what inflation is doing. And that's one of the biggest measurements that the Federal Reserve is using to kind of to figure out when those rate cuts will begin. Right behind that, the Federal Reserve Chairman is going to be making kind of a state of the economy address at 11 o'clock our time. So the lot going on tomorrow that could move the interest rates one way or another. Average interest rate is around 6.8 to 7% currently right now, but tomorrow's movement in the market could take interest rates one way or the other. Let's talk a little bit about interest rates specifically in terms of what are the characteristics that go into an interest rate. So first is credit eligibility. So the higher my credit score is, the potentially lower my interest rate can be. interest rates are going to be tiered at different FICO levels. So if I'm at 780 or better, generally that will offer the best interest rate opportunities. The type of product that I decide to elect, how much I decide to finance, what my down payment is. Do I decide to pay points for my loan? We covered that really briefly during the budgeting section, but those points are the ability to be able to pay additional costs to bring down that interest rate. And then we have the term of our loan. So if I elect to take a shorter term loan, that can potentially help bring down my interest rate. Now, we meet with all of our clients one-on-one for video consultations to design home buying plans for them. And during that session, what we do is we kind of figure out the best structure for them in their financing and review those rates and kind of fee structures that could help make them feel more comfortable in their housing budget. But that's kind of what goes into the characteristics of an interest rate. Now, credit's the number one thing that we look at when it comes to interest rates, as well as qualifying for different products. So in our classes, we always take some time to kind of talk a little bit about credit and how we can help put you in the best possible position from a credit perspective. I do think it's helpful to understand what goes into the FICO score calculation. And by the way, there's 3 different kind of major credit card scores when it comes to credit scoring. One, there's a credit card model. And by the way, the credit card model is used for most of your monitoring services, things like Credit Karma or the different tools offered through the different agencies. There's also an auto score model. And finally, there's a mortgage model. So from a home financing perspective, we're going to obviously use the mortgage scoring model. And so let's kind of take a look at what that weighting looks like for the score calculation. So here's what it looks like over here on screen. 15% is going to be how long have I had credit? So the more mature my credit file is, potentially higher my credit score could be. 20% is going to be how much new credit am I trying to get access to? Do I have new inquiries on my credit, hard inquiries? Am I opening new accounts in the last 6 to 12 months? Those are all going to be part of that 20% weighting. 30% is going to be how much revolving credit am I using? Also known as credit utilization. So if I have, let's say, $10,000 in credit limits on my credit cards, and I have a $5,000 credit balance, that means I'm at 50% utilization of credit. Now, ideally, we want to be at 10% or less in credit utilization. Now, if we've kind of charged up our credit cards a little bit, we're at 80 or 90% utilization, our first step would be to try to get below 50% utilization. Now, let me give you a quick tip on how to manage utilization when it comes to maximizing your credit score. So if you have some time over the next day or so, take a look at your most recent credit card statement. On that statement, you're going to find 2 key dates. One is the due date, which obviously we're all aware of. The second date is the billing cycle or statement date. And why that second date is important is because the statement date is the date at which the credit card issuer closes out all the purchases or credits that you've had to your account. And then that information gets sent out to the credit bureaus with your existing balance, what your minimum payment is, what your credit limit is, all that stuff. Well, if you can get in the habit of paying down those credit balances before the end of the statement date, what's going to happen is you're going to give yourself lower utilization and in turn have a potentially higher credit score. So if you can kind of manage to the statement date versus the due date, that's going to give you a better opportunity. Because if my due date's on the 5th, but my statement date ends on the 20th, it's almost too late by the time I get to the due date to be able to help make that big impact on my utilization of credit. The last weighting is going to be payment history. So that's how I paid my bills, right? So late payments are rated in 30-day lates, 60-day lates, and 90-day delinquencies. So the more severe I'm at on the late spectrum, the bigger impact I'm going to have to my score. Now, late payments or major events on my credit score are going to be the most impactful in the most recent 12 to 24 months. Now, every loan program has a minimum credit score requirement. We have some of them on screen right now with the FHA loans, conventional loans, some of our first-time buyer options, as well as for our veterans loans, the VA home loan. So those all have various credit score requirements. Now, as a lender, we always take the middle credit score of all 3 agencies. So for example, if my top score is 740, my middle score is 720, my lowest score is 700, we're going to take 720 as a score for qualifying purposes. Now, if I decide to apply jointly with my partner and my partner's 700, 680, and 660, then we're going to take 680, which is the lowest middle score between both applicants. Now, one of the things I want to just spotlight for you on kind of tips around credit, which would be around account closure. And we're talking specifically about revolving credit accounts. So if I've had an account, for example, let's say for the last 10 years, and I decide to close out that credit card, when I close out that credit card, it does two things. One is it takes away all the 10 years of history I've had with that creditor out of the length of credit component for the credit scoring model. Two is it can also impact your utilization of credit because now I've lost 10,000 or maybe whatever the credit limit is. I've lost that now out of my utilization aggregate total. So you want to be really careful before you close out accounts because it could negatively impact your score. Now, when we look at late payments or past events that are negative items on our credit, there's kind of a guideline for how long those things will remain on your credit report. So I provided you with a matrix here so you can kind of check that out. You know, if you've had hard inquiries on your credit, they'll be on there for 2 years or less, but the impact to the scores within the most recent 6 to 12 months. I didn't want to forget to tell you that, you know, starting our process with our team, we always start with a soft credit check. And the reason why we do that with our team is because, you know, our first time buyers, especially, the timeline varies for them in terms of when they decide to purchase a home. So we don't want to necessarily put that impact of a hard inquiry on their credit, not knowing when they will be expected to buy. All right. And we're going to move on from credit. We're going to talk a little bit about student loans. Before I do, I want to make sure I'm not missing anything in the Q&A. So we had a question that came in. I'll just answer this really quickly, which is, what are your thoughts on first-time buyers looking into pre-foreclosure, foreclosure homes? There's nothing wrong with first-time buyers looking into pre-foreclosure, foreclosure homes. Quite honestly, there's not a lot of those options out there unless they're really distressed or really bad condition properties. I think in terms of, unless a first-time buyer has resources to put into a property to renovate, you know, some of the more challenged properties that have, you know, lots of just, you know, repairs that need to be worked on, that should be avoided by first time buyers unless you have additional resources. Most of the first time buyer programs that we're going to talk about tonight require the property to be in a certain level of condition. So you can't do like any type of like major renovations or have like a kind of a rebuild project. It's going to have to be more of a turnkey type property. All right. Okay, don't think I missed anything in the Q&A. So again, if you do have any questions, go ahead and drop those in there and I'll get those answered on air. Let's talk really briefly about student loans. Now, for many of us, student loans are in repayment now. Maybe you're back in school right now and you're in deferred status. Whether you're in forbearance or deferment, we do have to still count a minimum payment into qualifying. Many of us could be on income-based repayment programs. That is allowed in financing. So in our example on screen here, if I had $75,000 in debt and my income-based repayment amount was $250,000, that $250,000 is what we would use for qualifying purposes. But if we're not in a payment arrangement, we'll use the different numbers. Basically, for a conventional loan, we're going to use 1% of the totals of the student loans. For an FHA loan, we're going to use 0.5% of the balances. So, you know, that can make a big difference from a qualifying perspective. So, you know, obviously, if you're on an income-based repayment amount, that's going to be the lowest option generally. Many of our clients are in public forgiveness on their student loans, which generally is a 10-year period. Even if we're in that type of program, until the loans are completely forgiven, we still have to count a minimum payment for qualifying. And I do know there's also student loan forgiveness of debt happening right now. So whenever we get documentation supporting that, then we don't have to count that in the qualifying. But until that happens, that would still be factored into what we call as a debt to income ratio calculation. You're going to learn a little bit more about that in tonight's class as well, too. Last thing I want to just touch on student loans. You know, we do have some clients that are back in school, maybe working full time, but also want to apply for a mortgage. If you're back in school and your student loans are deferred because of that, there still is a minimum payment that has to still be counted for the qualifying. All right. Let's talk a little bit about loan programs. And so we're going to spotlight 5 programs for you in tonight's class. We're going to talk more specifically about two of those, which will be the conventional and FHA loans, but I want to give you kind of a high level what each one of those products look like. So let's kind of dive into a conventional loan product. And as a first-time buyer, the minimum down payment on a conventional loan is 3%, up to a loan amount of 766,550. Now, when I go beyond 766,550, there's another kind of threshold of loan amount. It's called high balance or super conforming loan amount. Depending on where you're at in the states purchasing. So in California, for example, if you're in LA County, you could go up to 1.149 million in loan amount. If we're in the Santa Barbara market, it'll be a little bit smaller for Ventura County. If you're in Northern California, it'll look a little bit different. So there's different various high balance loan limits that you can get to in different parts of the country because they're considered high cost of living areas. Now that does elevate the minimum down payment from 3% to 5%, even as a first-time buyer, if you exceed the loan amount threshold of 766,550. So that's for the conventional loan. When we think about conventional loans, those are Fannie Mae, Freddie Mac loans. Conventional loans occupy about 70% of all originated loans across the country. Okay. And then the next product is going to be the FHA loan, which FHA loans generally have a minimum down payment of 3.5%. There is no distinction between high balance really and conforming. In say Ventura County markets, you can go up to 805 in terms of loan amount. That loan amount level does vary by the location of the property. With an FHA loan is a federally insured loan. Does have a little more leniency from a qualifying perspective, lower credit score requirements down to a 580 score, as opposed to the conventional loan that has a 620 score as a minimum. We're going to do a comparison in just a bit around mortgage insurance, because when you look at either a conventional loan or an FHA loan, with a conventional loan, you do have mortgage insurance when you put less than 20% down. FHA loan is going to have mortgage insurance regardless of your level of down payment. Okay, so that's the Federal Housing Administration loan, government insured loan. And then the next product is a VA loan. That's for our veterans that have served and have eligibility for the VA home loan. That's a zero down payment option. For some of our veterans, they may have exemptions to what we call the VA funding fee, depending on their disability status with the VA. The VA product's an amazing product that, again, provides a zero down payment option. You can go up to $1 million plus in loan amount. Minimum credit score is 620. A lot more flexibility in the VA home loan product to help serve our veterans for home ownership. Next product is the USDA loan. That's a United States Department of Agricultural loan, allows you to purchase in like more rural areas. And there's two big criteria with USDA. One is it has to be in a USDA designated geography. Two is there's income limits based upon the household size using the USDA product. And then finally, there's the jumbo loan. That's for clients that need to buy beyond what Fannie Mae, Freddie Mac, or maybe FHA loans can support from a financing perspective. Generally, there's a minimum credit score of 680 required on the jumbo loan product, and the down payments tend to be a bit higher. They're usually 10 to 15% down payment levels. There's also additional asset requirements that come along with the jumbo product. Generally, you're going to need to have what we call as reserves. And reserves are assets that I have left behind after I've contributed my down payment and my closing costs. Usually it's going to be 12 months of my monthly payment. So if my mortgage payment is, let's say, $8,000 a month, we'll take 8,000 times 12, that's $96,000. We'll need to have that much in funding in additional assets. All right, let's spend some time talking a little bit about mortgage insurance. And we're going to do a quick comparison looking at conventional versus FHA loans. Before we do that, let me just answer a quick question, two questions in the Q&A. One is home buying doable for a single income person? That's going to be a question for you in terms of like what budgets work best for you in your household. So it absolutely does happen. We work with clients in different economic situations. So whether it's single or dual incomes, and that's something we would love to be able to kind of help, connect with you and kind of share with you what budgets could look like based upon your income level. Second question I had, which is, are there any loans that help public workers or public school teachers? So not necessarily specifically to public school teachers or public workers, but there are first-time buyer programs that are available for those that are purchasing in California. Every community has different first-time buyer programs available, and we're going to spend some time talking a little bit about it tonight, but not necessarily specific to public school workers. Now, we do have discount programs that we offer to public school teachers, but we also have a similar discount that it's offered to our Gaucho alumni too. So let's talk a little bit about private mortgage insurance, and we'll first talk a little bit about conventional loans. And there's different ways to pay conventional mortgage insurance, and there's the few of these ways look like this. You can pay it monthly, so you have a monthly amount included into your mortgage payment. You can do split mortgage insurance, where you pay some of it up front, some of it in your mortgage payment. There's also single premium, where you completely buy out the mortgage insurance. And then there's lender paid mortgage insurance, and that's where you elect to take a slightly higher interest rate to buy out the mortgage insurance. Not a really common option that buyers will do, especially in today's market where interest rates are already high enough that that it doesn't make a lot of sense to do that. The most common option is the monthly mortgage insurance option. The reason why that is because at some point when you have 2 years in your loan and you have 20 to 22% equity, you can apply to have the mortgage insurance canceled. Now, mortgage insurance is not a one size fits all type of situation. There's a few different characteristics that go into what the premium is going to be that you pay for mortgage insurance. It has to do with credit score, what your down payment is, and then how much you decide to finance. It's almost very similar to car insurance, right? So depending on what my driving record is, the type of vehicle I'm insuring, those things could impact my auto premium. Works very similar with mortgage insurance. Now, I will say for those of you that started your calculations, your home searches on Zillow or Redfin and use some of their calculators that they have online, the mortgage insurance might look a little bit different than what you're going to hear in tonight's class, because those calculators online don't generally take into consideration those three items: credit score, down payment, and amount financed. So if we looked at a conventional mortgage insurance calculation, and we look at kind of the bottom of the screen here, if I finance $700,000, let's say I had a 740 credit score and I put 3% down for my financing, I'm probably looking at mortgage insurance around $209 per month. Now, the higher I can move my credit score, the more I put down, the lesser that mortgage insurance cost is going to be. Now, switching from conventional to FHA mortgage insurance, FHA mortgage insurance is a government insured loan. It does have two components to mortgage insurance. One is there's monthly mortgage insurance, which is 0.55% of my loan amount. There's also upfront mortgage insurance, which is 1.75% of my loan amount. That gets added into my total amount finance. Now, different than the conventional loan, the FHA mortgage insurance can only be canceled if I decide to refinance out of my FHA loan into a conventional loan. So FHA is going to be a little bit more expensive because of the upfront mortgage insurance. The monthly, which we're going to look at right now, is also a little bit more expensive. And let's take a look at that. And then we're going to kind of talk about a little bit of a comparison here. So if we finance the same $700,000, we have now our monthly mortgage insurance premium is going to be the 0.55% factor. That puts our monthly at $320 on the FHA mortgage insurance. The upfront mortgage insurance gets added into the total amount finance, which would be $12,250 or 1.75% of that $700,000. So when you do the kind of the analysis, you can clearly see FHA is a little bit more expensive, but I think we got to be aware that not every client is going to fit in the conventional loan product. And so FHA gives us a little bit more flexibility from a qualifying perspective. The FHA credit score minimum is a little bit lower than the conventional product. If I've had some past challenges, maybe a late payment, maybe I'm a little bit overextended in some of my credit, FHA will be a little bit more okay with that as opposed to like a conventional loan product. But ultimately, as we meet with our clients for consultations and design some options, we'll figure out what the best route for you to take in your path towards homeownership. Now, as we start on that path, there's different documentation that we need. Here's kind of a checklist of items that we generally would need to start gathering. Usually it's the last 2 years of taxes, W-2s for the last 2 years, last 60 days of bank statements, as well as our last 60 days of pay stubs. So that's kind of what you would generally have to start gathering in terms of documentation. Now, I always like to kind of talk a little bit about employment or income sources during our class to just give you a sense of what's generally needed, but some different scenarios that might be helpful for you as well. There's a kind of a misconception in the marketplace that you do have to have 2 years on your job to qualify for home financing, which just really isn't the case. What we look for is 2 years of education and or work history. So if one of the examples I use in our classes is, if I graduated from UCSB with an accounting degree in the fall, and I spent 4 years at UCSB, and now I'm working for an accounting firm, just started this year, I can use my educational history to support a full 2 year history needed for my mortgage financing. So theoretically, I could qualify for home financing with my offer letter that I have for the new accounting firm that I just joined this year. Okay, so it's a 2 year requirement, but looking at a full 2 year history. In some cases, we've had some clients that are qualifying for a mortgage today, but considering making a move career wise, if they have an offer letter that they can provide us, we can use that offer letter to basically qualify them for their mortgage financing. Now, in some cases, we have clients, especially like in the healthcare industry, we'll see at times where some clients are working in dual employ or working for dual employers. Maybe I'm working for one clinic for 30 hours a week, another clinic for 20 hours a week. Now, in that case, I do have to show that I've been basically employed in both sources for 2 years in order to count both sources of income. The 2 year requirement also comes into play if I'm self-employed. So if I'm working as an independent contractor or I have my own business, I do have to show that I have 2 years of consistent tax filings in order to consider that income. And then finally, another question that comes up is additional sources of income. So let's say, for example, I'm going to apply by just my individual self for my financing, right? But my partner does contribute to our income and expenses. If my partner is not going to be part of the application, then I can't consider that income from a qualifying perspective. So it would just be on my income. Now, there are some programs that will allow like rental income sources to be factored into the equation. Like if I'm renting a room right now, or I'm buying a house that has, rental opportunity, at times those additional streams of income can get factored into qualifying. Now, one of the analysis that we do as a lender is looking at income versus expenses. And we call that analysis the debt to income ratio analysis. And it's really a simple equation. We're looking at gross monthly income versus what our monthly expenses look like. But the expenses that we're considering are things like the new mortgage expense that you're going to have, and which is shown here on screen. So principal and interest of the loan, property taxes of my new house, homeowners insurance. If I'm putting less than 20% down, mortgage insurance, maybe I'm buying a condo, maybe a townhouse, we'd want to factor in homeowners association dues. And then other debts like credit cards, car loans, student loans, personal loans, those would be considered like other debts that get added into my expenses. And then we take those expenses versus our income and we come out to a calculation. So here's kind of an example here. We have a client that has $3,000 in monthly expenses. They make $8,500 a month. Their debt to income ratio would be 35.29%. The question I get often from clients is really, where should my debt to income ratio be? And everybody has a very, very tolerance level of what debt to income ratio could be for them. But the comfort zone I've seen in working with hundreds of clients throughout the year is about 33 to 36% debt to income ratio. So that's generally where we see kind of the comfort level. But beyond debt to income ratio, we're more concerned about affordability. And that's a conversation that we have with our clients during our consultation, is understanding where you're at right now. Where do you want to go from a monthly expense perspective? Then how can we best support you with all the resources and tools that you need to help achieve homeownership? Okay, so the last component to kind of really building a home buying plan is understanding more about savings that I'm going to need, or assets I'll need, I should say, for purchasing my home. Now, we learned a little bit more about the minimum down payments in our product section. This screen kind of highlights some of the documentation that we generally need, which we talked more about it earlier too, which is, last 60 days of bank statements. That's all great, but, other sources can also be introduced if it works for you in your budget, which would be like 401ks, 403bs can potentially be used. I would encourage you to talk to your tax or your financial advisor before you kind of dip into those assets. Even gift funds can be allowed, and that's where a family member is helping you out with some resources to purchase your home. Now, there's kind of two challenges when it comes to home buying for most first-time buyers. One, it could be credit, because maybe we're just a little overextended, or we're trying to, get out from under some debt. Two, it could be just savings because I just haven't quite saved up enough. We're going to talk about first-time buyer programs in just a few minutes, but I want to give you another kind of resource with regards to savings. And it's kind of a simple approach, but I think it's effective. And that is creating a savings plan for yourself. So, and we want to first start with our budget. And so if we look at what we're paying in rent right now, let's just make the math easy. Let's say I'm spending $2,000 a month in rent, but I think I can afford $4,000 in a mortgage expense, right? So right there, we have a $2,000 variance. So if we're trying to build up savings, what I would encourage a client to do is to start saving like you're paying a mortgage today. And here's what that would mean is, as I, get my paychecks and they're deposited in my account, when I pay my rent payment of $2,000 a month, pay my savings account an additional $2,000 a month. And so I'm basically essentially having outgoing expense of $4,000, but $2,000 is going into my savings account. So after 6 months, I've accrued what, $12,000. After a year, maybe I'm at $24,000, and now I'm getting a much better resource of savings to go towards my home purchase. So a little kind of adjustment in our budget, but can go a long way in savings. And that's not in considering even kind of high yield savings accounts that are earning 3 or 4% interest. Okay. We're going to talk about first-time buyer programs right now. Before we do that, I want to just answer a quick question in the Q&A, which is, what's the advantage of using pre-tax income as opposed to the after-tax income for this calculation? So it's not really necessarily an advantage perspective. It's just that's kind of the set guidelines that have been introduced by Fannie Mae and Freddie Mac and all lenders. That's kind of what the lending industry does. So they always use pre-tax. I'm not a big fan of it because we all know we don't net our pre-tax income, right? So that's why we have a conversation around affordability and what that looks like. But the pre-tax gives us a baseline for what that debt to income ratio looks like for you. All right, let's talk a little bit about down payment assistance programs. Since most of us are in California, you may or may not have heard of CalHFA, which is the California Housing Finance Agency, and we're a leading partner with CalHFA. And ultimately what CalHFA does is it provides support to low to moderate income households to achieve homeownership. And there's different resources that are available through CalHFA. And so I want to spotlight a few of the products in tonight's class. Our website has a full list of all the resources that are available for CalHFA, and we'll share some of that information back to you later this evening. But here's what some of the programs look like. The first product is the MyHome Assistance Program. Provides up to 3% of your sales price in assistance on a conventional loan, 3.5% of your sales price on an FHA loan. And what that is, it's basically a separate loan that the state provides to you in addition to your first mortgage that's at a 1% simple interest rate loan. And the interest does not compound, it's simple interest. And it's not required to be paid back until you either sell your home or if you decide to refinance in the future. And what we do is we kind of add that into a conventional or FHA loan to help ultimately reduce down the total out-of-pocket expense for the first-time buyer. Now, there's also another product that can be added on to the My Home Assistance Program. It's called the ZIP program or Zero Interest Program. It's an interest-free additional loan that the state would provide to you to bring down that out-of-pocket even further. In today's market right now, with interest rates being a little bit higher, the ZIP assistance program doesn't always fit for a buyer because it can elevate the interest rate up to about a full 1% from a standard first mortgage rate. Two of the big benefits with CalHFA is the fact that interest rates tend to be about 0.25% below market rate when we just use the My Home product. And of course, the My Home Assistance Program providing the 1% simple interest rate loan. If we were to look at our scenario of buying a $700,000 house, I want to kind of show you a quick comparison of using a first-time buyer program versus not. So if you purchased a home for say $700,000 with a 3% minimum down payment, plus your closing costs, which we generally recommend estimating 2 to 3% of your purchase price in closing costs. To buy a $700,000 home, I'm probably going to need about $35,000 to $42,000 out of pocket in expenses. If I was to substitute that with a first-time buyer program, now I could add in the My Home Assistance of up to 3% of my sales price. So I would get up to $21,000 in assistance from My Home. Now I'm taking that out-of-pocket expense down maybe to $14,000 to $21,000, so maybe a little bit more reasonable for our first-time buyers. And of course, if we needed the ZIP assistance program, that could be another add-on to help reduce that out-of-pocket expense even further. So great alternative to help us achieve homeownership versus trying to have this big savings goal. So, maybe from a timeline perspective, if our goal was 3 years to purchase, maybe that shortens it to a year or maybe a year and a half using resources that are offered to us from CalHFA. Now, there are minimum credit score requirements on the program. For the FHA product, it's 640. For the conventional product, it's 680. There are some lesser credit score requirements for some of our low-income housing clients. Those are clients that make less than 80% of the median income for the area that they're deciding to purchase in. We talked about debt to income ratio. This product will go up to 45 to 50%, depending on the credit score. One of the interesting things about the program is it did not consider income as a household. We look at income by applicant. And why that's important is because most of the products with CalHFA go up to 150% of the median income. Now, if I happen to exceed that with a dual income household, we could apply in just one name and potentially still stay within the income limits to be able to achieve benefits offered through CalHFA. And it is for first-time buyers. So a first-time buyer, by definition, is someone that has not owned a home that they've lived in the last 3 years. And it's eligible for properties such as single-family homes, condos, townhouses, even manufactured homes that are on land that is actually owned. Here's the income limits for the program. So I thought I would share that with you. You can kind of see those by some of our Southern California markets. If you're joining us from, I don't think I saw anybody from Northern California, but if you're in Northern California, depending on what county you're looking at, like let's say, for example, San Francisco County or Santa Clara County, you're at $300,000 in income limits. And that's all based upon the median income for those areas. All right, before we go into the process of purchasing a home, any questions that I can help answer from our audience? I know we're almost to the top of the hour, so I appreciate everybody kind of hanging in there with us. And we do have somebody from San Jose. Okay, cool. So for San Jose, first-time buyer program limit is 300,000. So, all right, well, let's go ahead and talk a little about the buying process. And we've kind of simplified this into the 6 steps of home buying. And we're going to kind of walk you through all the milestones of purchasing a home. And we've heard me talk a little bit about a consultation tonight. A consultation is a one-on-one with me to be able to design a home buying plan for you. It's about a 30-minute video session. Now, the output of a session on the consultation is to be pre-approved. And you've probably heard that terminology before. Pre-approval means that you have a certification that you can go out and start making offers on homes. So a lender has basically validated your finances, income, credit, your down payment for the home purchase. So that's all been validated. So the pre-approval is generally good for 60 days, but it can be recertified at any time. So you don't have to feel any pressure to go out and buy a house right away. We've had clients that have been shopping for 1 to 2 months before they find a home. Sometimes it's 1 to 2 years. It really just depends. So step 1 is to get pre-approved. Step 2 is now to start our house hunting. Now that could start online, which it generally does. But once it goes from online to in person, that's when you're going to start looking at homes in person, preferably with a realtor that can help kind of show you different options in your particular community. We have an amazing network of preferred realtors that we work with, whether it's in Santa Barbara, San Luis, the Bay Area, LA, Orange County, that are trained to help kind of support first-time home buyers. And realtors will help negotiate price. They'll order inspections for you. There is kind of an advocate to help you find the home that kind of meets your budget and certainly in the community that you're considering. The house hunting phase honestly can take kind of the longest part of this process because if we're looking for a certain community, it may be something that's just not available yet. Especially with challenges in inventory, it could take a little bit longer. But let's say we do find that home that works for us and we get an accepted offer from a seller. That means now we've started the escrow process. So that's step 3. And the escrow process can generally run 30 days. So from the time the offer is accepted by the seller to the time I get my keys to my house, it's about a 30-day process. Now we do have ways to kind of shrink that process down. We have our quick close program, which allows us to close escrow in 14 days, especially in today's competitive market. That's been a great resource for us. But generally, and the escrow process is about 30 days. Now, when the offer has been accepted by a seller, we start that step 3. You as a buyer generally will need to make a deposit, or we call it an earnest money deposit, within 2 to 3 days of the accepted offer. That deposit is usually the equivalent of 1 to 2% of your purchase price, but it counts towards your total out-of-pocket expense. Usually the same day that we get that accepted offer, you're going to get a call from me saying congratulations, kind of talk to you a little bit about your contract, some of the kind of the updated market conditions, and then we're going to schedule you for a follow-up video consultation, because now that we're now in escrow, we're going to go through all the details of your financing. And within a few days after we do that consultation, then we deliver to you disclosures for your financing. Here's a slide that shows you a little bit more about what earnest money deposit is. It again is 1 to 2% of your purchase price. It counts towards your total out-of-pocket expense. Now, in California, part of the real estate contract includes a contingency period. It is optional, but most first-time buyers have a contingency in their contract that states basically within the first 14 to 17 days of their contract, they can do some investigative work, like getting the house appraised to ensure the house is worth what you're paying for it, getting the house inspected, and your realtor would help organize that, and then finally getting your loan approved to ensure your financing is set and in place. And so that is important because that deposit that you've given in the first couple of days of the contract is protected by the contingency. So if for some reason that the home is just not the right fit for you after doing your inspections, you can still cancel the escrow and get a full refund of your deposit as long as you're in that contingency period. As we move through the process, step 4 is kind of more the administrative tasks of the financing, the processing and the underwriting of the loan. We'll generally have your interest rate locked in at that time. For most products, interest rates are not locked in until you have an accepted offer with a seller. Step 5 is going to be the loan approval phase. That's where an underwriter has reviewed all your documents, your credit, verified assets, and issues the loan approval. It also takes us to about 3/4 of the way through the process. So by that time, we've received your appraisal back. We have that underwriting approval. Now we're going to start preparing for the closing of the transaction. We're also going to issue to you a final closing disclosure, which basically gives you a 3-day cooling off period before we get to the very last milestone. That's called closing. And closing includes signing final documents in person with the public notary. That process will take probably about an hour or so. You'll also send in your final funds that are due for the purchase of the home. The money gets all reconciled by what we call an escrow team. That also includes your financing. So we wire in the financing for your loan funds. That money gets balanced out. Once it's all balanced, they'll take documents and record those with the local county recorder's office. And they record 2 kind of important documents. There's a grant deed that transfers ownership to you, as well as a deed of trust, which is your agreement to repay the loan. And after all those documents get confirmed as recorded, then we get a chance to celebrate because now you become the official owner of the home. I get a chance to make at least one of those calls per day. It's the best part of my day because we get a chance to celebrate the huge accomplishment. It doesn't come with obviously some, stress and anxiety as you go through the process, because remember, this is probably going to be one of the biggest purchases you make in your upcoming financial futures. But when you get there, it's obviously super rewarding. All right, so that's our 6 steps of home buying. Now, after attending tonight's class, if you're thinking you too want to get on the path towards homeownership, I would love to get connected with you to kind of put your own home buying plan together. Here's what it looks like to move forward in the process. We call it our Get Started information. You would complete an online application, really simple online application you can do from mobile, you can do it from desktop. You would then upload proof of income and assets, and then you would schedule your video consultation with me so we can do that 30-minute session to map out a plan for you. Now, you shouldn't feel like you have to go out and buy a house this year. Most of our clients that attend classes are on maybe a 1 to 3 year cycle of when they're going to buy a house, but we want to help design some goals and objectives for you in homeownership. So when that time comes, you have all the tools and resources that you need. Now, after tonight's class, you may just have some questions, individual questions about credit or savings or products. we can still get connected with you, but we would like to do that through like an introductory call. So you can schedule that time with us and we'll get a chance to answer any of those questions you have. And we're going to carve out some time in just a bit for a little bit more Q&A. Here's what the consultation looks like. And by the way, it's a free service we provide. So, through that free service, we want to make sure you have all the right answers to help you better understand what your budget looks like. We want to kind of understand where you want to purchase, what programs are going to best fit for you. Can we help kind of design a credit plan for you, maybe a savings plan, really to all kind of align together to help you on that path towards homeownership. We also have some great resources that are available to you, like our mobile tool. You can start the application, as I mentioned earlier, right through mobile. You can follow the progress of your loan as we go through different milestones. You can also run different calculations as you're out viewing homes. Mobile is a great tool to help you in this journey as well. Obviously, we're super proud of our Gaucho partnership. This is something that's been fantastic. We're now doing, I think, our second workshop for 2024. We have another one coming up in a couple months. We have also other partnerships across the country. So like I said earlier, if you have friends, family, coworkers that think would benefit from these educational tools, we'd love to have them attend one of our free classes. You can check out all of our class schedule by visiting us at mortgageeducate.com. We also have a dedicated landing page for our Gaucho family. It's at gauchosmortgage.com. So you can also check out the list of benefits and schedule your consultation and start the process all right there from that landing page. Here's all my contact information. So after tonight's class, if you do have any questions, feel free to get connected with me. Shoot me a text, email, and we try to put a lot of good content on our social channels on Instagram. Our YouTube channel will house tonight's class, so you can check out some of our past recordings as well as this class on our YouTube channel. You can follow us on our Instagram or YouTube at JMATA Mortgage. So it's JMATA Mortgage. We'd love to be able to get connected with you there as well. So that gets us to the end of tonight's class. We have quite a few of our classmates that are still hanging out with us. So I'd love to still open it up for some more Q&A to answer any questions that maybe that you have after going through tonight's class. I did have a question that I missed earlier. I think it had to do with the home buying certificate, I want to say. So on the first-time buyer program, there is a home buying class that's required. We don't recommend taking that class at least until you find a home that fits your needs, but you can certainly take it earlier if you want. But the state does require 8 hours of online education. Once you receive that certificate, it's good for 1 year, and it can be renewed as well too. So I think that was the question I had earlier in the Q&A. All right, let's see. Okay, thank you for joining. Appreciate it. Drop down the chat. Any questions from our audience that I can answer? Okay, all right. I think we did good. I appreciate the hearts. That's awesome. Okay, cool. I think we did it. Well, thank you so much again for attending tonight's class. I'd love to get connected with you at a future date to talk a little bit about your home buying plan. I wish everyone a wonderful evening. Enjoy the rest of your week, and we look forward to connecting with you soon. Have a good night.